Coming up in today's episode, mega cap tech bounces back, global growth outlook deteriorates, several European central banks increase rates, Powell thinks inflation's going to cool without significant job losses, our new custom indicator for TradingView, and Elon Musk and Mark Zuckerberg want to fight each other in a cage. Welcome back to Click Capital, everybody, your go-to channel for all the latest data, news and charts from the markets. And a bit of a reversal of what we saw yesterday, with the hardware side of the economy coming off a bit today, and once again, mega cap tech popping up there. Although we're continuing to see weakness in the semiconductors. And so we had Jay Powell wrap up his 2-day testimony in front of Congress today, and he thinks we're going to have a miracle outcome where inflation will cool without any significant job losses. However, like some economists model, they think unemployment rate will need to get closer to 10% to get inflation back down to target. Powell went on to say that a strong majority of Fed officials think the Fed will engineer 2 more 25 basis point hikes by the end of the year. And it's no surprise that he continues to talk up a soft landing or no landing scenario. However, this is not the first time Jay Powell has forecast inflation to come down, so let's take a look at the data. And here in the thick green line is what the actual core PCE inflation number has, their preferred measure of inflation. And here at each of these points, the dotted lines has been what the Fed has forecast inflation to do going forward, and you can see they have been consistently wrong. We're saying inflation is always on the verge of turning down, saying for a few months back here, inflation's only transitory, don't worry about it. And then at every single point, they've forecasted to come down, and even till now, he's still forecasting inflation to come down towards 2% even in late 24 next year. So the Fed doesn't really have a good track record at making forecasts, they're more just reacting to what's happening. And we've got stubborn inflation around the world, that's why central banks around the world are continuing to hike rates. Even as Europe is now technically in a recession, and China as well has been fighting declining growth and trying to revamp their economy. And we saw today Bank of England with a surprise 50-point rate hike. That's because their core inflation was up 7.1% year on year. So they're tracking a bit higher than what the States are. And that was their 13th consecutive increase. The Swiss Central Bank increased their rates 25 basis points today and signaled more further rate increases to come. And same story out of Norway as well, increasing their rates to a 15-year high. And so we live in a globalized world, and inflation is in sync around the world as a lot of our supply chains are interconnected, and so there's still persistent inflation around the world. And what would be a battle for the ages, and I'm sure a lot of other people would pay good money to watch live on pay-per-view, would be a cage fight between billionaires Elon Musk and Mark Zuckerberg, who've hated each other for years now. And recently Mark Zuckerberg has been building a competing app for Twitter, as that's been his business model for years, is just to copy what anything else out there that's working and try and do himself. Elon recently came out on Twitter and said he's up for a cage match if he is, and then Zuckerberg responded on Instagram, send me the location. Then Elon replied the Vegas Octagon and went on to say he has a great move called the Walrus where he just lies on top of his opponent and does nothing. And since Zuckerberg has been training in mixed martial arts recently, sportsbooks are already pricing in Zuckerberg as the favorite, with him at -400 and Musk at +250. And UFC President Dana White saying they're both serious and calling on them to create a date for the match. That should be a real interesting one if that goes ahead. Another news out today, assets invested in ETFs have hit a record 10.3 trillion worldwide, and that's while other asset classes are still well below their previous highs. And this is just further acceleration of the secular trend from investment from mutual funds into ETFs, which are more transparent. Got some more interesting charts out for you today, and this one really illustrates what the work from home trend kicked off from the COVID pandemic has done to office occupancies and caused a huge issue in commercial real estate, further exacerbated by rising rates. And so we can see just a little over 2 years ago, occupancy rates at major cities around the states were between 10 and 28%. And now we've got cities such as Houston above 60%, is now above 50%. So half of all offices are sitting empty, and a lot of other major cities are creeping up to that 50% mark as well. And for the first time in decades, we've now got US government 3-month bond yields at 5.21%, which now above other major asset classes, the 10-year yield, corporate bond yields, and the SP500 earnings yield at 4.77%. And this is the first time we've seen 3-month bond yields above the stock earnings yield since the late 90s. And here's another chart to illustrate how extreme stock market valuations are compared to their historical norms. So currently we've got the US market cap divided by GDP at 232%, and that's currently at 97% in its historical range. Same with enterprise value versus sales at 96%, price versus book 92%, Cash flow yield 88%. The yield gap versus the real 10-year yield 89%. And we can see the historical percentile for the stock market valuation metric for the median stock is at 94%. So on many valuation metrics, especially earnings yield versus short-term bond yields, the stock market is very expensive. But does that even matter anymore? Because as this chart illustrates, since we've had the Fed put, where the Fed just always steps in and backstops the market anytime there's trouble, it seems though the market has learnt that and maybe have structurally changed and just can constantly lean against the Fed with that insurance policy, hence the name the Fed put. And this chart here shows the average one-day returns after a down day. And we can see currently in 2023, we have that buy the dip strategy is having its third best year ever. And that 10-year moving average is been in an uptrend ever since the Fed put buy the dip era has been in place this last 2 decades. And since the Fed has absolutely flooded the system with liquidity, taken their balance sheet up to almost $9 trillion with fake artificial money, rock bottom interest rates for over a decade, maybe they truly have distorted economic reality in the markets, and valuations will stay elevated for longer. In economic data out today, we've got initial jobless claims coming in a little bit higher than expected at 264,000, and existing home sales growing a little bit better month over month, 0.2%. Fed Fund futures price in a 77% chance we get a hike at the next Fed meeting. Fear and greed index still really elevated at 80. Options market still loading up on calls. Pretty good pullback in dark pool buys today. The DIC's down at 48%. Corporate insiders buying their stocks fell to multi-month lows, with sales still significantly outpacing them. Okay, back into the charts, and today I wanted to show you guys my newest custom indicator for TradingView, and that's called Sector Trends Table, which you can see here. And basically all the indicators I develop is because I want to be able to understand and analyze the market in certain ways, and when I look around for anything else out there, I just can't find it. And what this sector trends table is, it shows you 25 symbols of popular ETF sectors, SP500, the Qs, utilities, all the way down to biotech. And you can configure this table yourself. You can add in whatever symbol you want and change all the settings. And basically it shows you where the price of each ETF is relative to the simple moving averages of 5, 20, 50, and 200. Again, you can configure those. So it gives you a bit of a bird's eye view heat map of where the trends are and then the market. And in the immediate term with the 5-day moving average, then the short term 20, medium term 50, and long term 200-day moving average. And so we can see here most of the market is in a bit of a pullback right now, except for consumer discretionary, which is green in all time frames. Same with healthcare. And then we can see others like regional banks, oil and gas, energy and real estate is in downtrends on all time frames. So this just gives you a quick look and helps you identify where the major trends are in the market and in each subsector of the market. And so we can see a lot of the market is above their long-term and medium-term trends. We can see that with all the green cells, and we're just having a little bit of a pullback right now. And you can easily toggle this indicator on and off by using the hide button here. Okay, let's keep moving forward and analyze today's price action across the board. So like I said at the start of the video, a bit of a change from yesterday's price action. We saw the Russell come off 0.7% today, and the winner was the NASDAQ up 1.1%. And this looks like the market is persistently high in this uptrend, just acting pretty stubborn, doesn't want to give up or do a proper pullback or correction. But we do have a bit more weakness out there internationally. There's Canada's TSX coming off, approaching multi-month lows. Bit of weakness in the FTSE. And the DAX coming back down below its 50. The Nikkei holding up pretty well. And we saw the Aussie come off yesterday and China was flat. And look at the VIX, still struggling to find a floor here. Now under 13 at 12.9. And that divergence with the VVIX index continues. Breadth came off a little bit here today, 68% of stocks above their 20-day average. And we actually saw the amount of NASDAQ stocks making new lows today outnumber the amount of stocks making new highs, 50 to 44. Growth versus defensive sectors did gap down today, but found a bit of a bid. And there's growth versus value stocks still holding up there. And small caps versus bigs trying to find a bottom here. And there's inflation expectations as measured by the TIP/IEF spread, still on a slight uptrend ticking higher. Same with the 2-year government bond yield, still on a nice short-term uptrend. Found 480 today, 10-year holding up as well. And the December Fed Fund futures actually found new multi-month highs today at 535. And so the market is now pricing in that rates are going to increase going into Christmas. High yield bonds back below their 50-day, and the dollar looking to find support at this major support zone at 102. There's a look at Bitcoin just hovering around that 30,000 level. We did just put in a bearish 7 count. Bit overbought up here, and we'll see if the weekend crowd can get this to break out above 30,000 for the first time in a while. A little bit of a pullback in commodities today. Crude continues to track sideways, now under $70 a barrel. There's a look at the cannabis ETF, which I recently invested in. And out of the 25 sectors I track was the winner again today. The AI ETF bots continues its pullback. Clean energy ETF pulls back to its 50-day. And regional banks as well, back down to their 50-day. REITs are still looking weak. And as we saw in our sector trends table, healthcare continues to hold up, one of the best sectors out of them all. There's a look at the BlackRock barometer. JP Morgan as well. It was flirting with these multi-month highs, looking like it may break out, but it's done a bit of a pullback here today. And Tesla was downgraded today by another Wall Street analyst. Had a pretty good gap down, but just found an instant bid and actually closed higher than yesterday's close. So this thing as well is not going to pull back too easy. NVDA continues to consolidate up here, and Apple actually found new all-time highs, but did put in a bearish 9 count. Microsoft continues to consolidate on these bearish divergences. Amazon up 4.2% today to new year-to-date highs. Google looks to have found support at its 50-day, and AMD just closed underneath its one. Bit of weakness out there in meme stocks today, with AMC down 8%. SMCI looks to have found a little support. Virgin Galactic pulls back today after getting overbought yesterday, and we're off significantly in after hours as I speak, down 14.4%, trading around 450 around these levels here. There's RCL continuing to coil up here. Carl Icahn stock still can't close above its 50, and a bit of weakness in the regional banks and the big guys today as well. There's a look at our S&P 500 oscillator, currently at 57.4 and curling down. Okay, back to the main indices, and there's the S&P 500 just holding up here, still in this short-term uptrend. Did see the equal weight come off today, 0.41%, and I just took advantage of that early morning weakness again to further trim down my shorts and move the portfolio back more closer to market neutral, just 20% net short now. And going forward, I'm probably just going to stay market neutral, maybe with a slight bearish tilt, as the market just remains stubbornly high and just seems to be ignoring all economic data out there, the prospect of higher rates, deteriorating global growth, super high elevated valuations, and so on and so forth. And like I just showed you in that chart earlier, of the buy the dip strategy having its third best year, which means the market just can't stay down for long without getting dip bought. And I think that's because the market just knows that Jay Powell and the Fed has always got their back, so they can always lean against it. And that's why every dip will always be bought. And just take you out to a weekly chart on the S&P 500, that doesn't mean we can't have another bear market again. But for now, we just have to respect the fact that there is a lot of momentum, especially in the NASDAQ. Even though we're on about a 15 count on the weekly chart here at a big resistance zone, the market's still got a lot of work to do technically before we can say this is definitely a short or medium term topping area and we can have a proper correction or pullback. So once again, another tricky environment. Hard to say with conviction what type of market exactly we're in. And so for that reason, that's why I'm getting back down towards neutral and probably just going to keep a slight to moderate bearish tilt. As because of all those macro reasons that I've showed you, it's just hard for me to tilt the portfolio net long. And if you haven't already, head to our website, clickcapital.io, and wait for the pop-up, and you can get our trend candles indicator valued at $39 for free. All you got to do is enter your email name, and you just need a free TradingView account, then you just put in your username, and we'll give you access to that indicator today. And stay tuned in, because we're going to offer you guys a deal on all 20 of our custom indicators for TradingView next week, and I'm sure a lot of you are going to find value in that. Alright guys, that's it for now, so thanks for sticking with me, and I'll see you again for the last day of the week.